And the major intention is to make sure whether the company is having the necessary funds at any point in time, make sure whether the company is having the necessary funds to execute its daily operations. That is the fundamental behind the effective working capital management. Does the company have sufficient resources at any point in time, whether it has or can it have access to? Can it get the funds from somewhere immediately to maintain the day-to-day operations? Right? And so whatever the excess cash that they have, did they invest it in a much better manner so that it can be converted into cash that quickly? Because at any point, if the company is having insufficient funds, all I need to know is, can it get them from somewhere quickly? What is the way out? What are the kind of avenues that are available for the firm to get that funding from some other sources quickly? Or is it possible for the firm to sell off some of their assets or get into some kind of negotiations with the bank to get some additional credits? So what are the kind of avenues that are available with the firm, especially if the cash is insufficient with them? At the same time, if the cash is surplus with them, what are the avenues that are available with the company? How well it is handling that surplus cash? So all these things are a part of the effective working capital management process of the firm. So the important objectives, especially when any firm is looking at working capital management, look at how adequate is the cash that is available. Too high, too low, both of them are a problem. As I've just now said, too low means, can I get it from somewhere? How quickly can I get? What are the ways that are available for me to get the funding as quickly as possible? Similarly, if it is too high, what is that I am doing with that idle cash? I could have put that cash somewhere. So handling of cash and any kind of short-term assets that are there, how well the company is able to handle the short-term assets, especially with respect to the accounts receivables and with respect to inventory or even short-term investments. How is the company able to handle all these short-term assets? How quickly they are or they can be converted into cash? How well the company is managing the short-term payments to vendors? What is the kind of credit policies it can struck with respect to the vendors? So something to do with the short-term payments to vendors, probably to employees. What are the kinds of options that are available to the firm? How well it's able to manage all these aspects? And if the cash surplus exists, what are the various avenues that are available to the firm to invest for short term? What are the avenues that are available? Where all can it invest? And probably, if it is falling short of cash, what are the methods of short-term borrowing that are available with the bank? Did it make any kind of initial arrangements with respect to short-term borrowings with the banks? What are the various sources the bank is typically getting into? All these things go as a part of the effective working capital management function of the company, right? So what is my lending policy, or probably what is the credit policy that I give to the customers? Is my credit policy effective, right? And how well my company is good at collections in case we have given something on credit? And what are the kind of forecasts that I can do with respect to the credit in future, with respect to the cash collection in future? All these things go as an integral part of the effective working capital management of the firm. So typically looking at the various factors that can impact the working capital management, I can look at one from the internal factors, the other I can look at a few of the external factors that can typically impact the working capital management of the firm. The size of the firm. For a bigger firm, it's a big challenge to go with working capital management. A lot of things need to be considered. A firm which is growing drastically, the working capital management process need to be very clearly understood. Depending on the organization structure, whether it is centralized or decentralized, the working capital management will differ. So a good understanding of the organization structure can lead us to taking good working capital based decisions. And what are the kind of borrowing or investing positions the company is typically in? How well the company can what are the policies with respect to borrowing and investing in the short term? All these things drive the effectiveness of the working capital management. And from the external perspective, how are the banks? What is the attitude of the banks with respect to the lendings and short-term investments from the companies? How effective is the banking sector in that particular country? What is the current situation of the interest rates? So depending on the interest rate, the banks may accept more and more inflows, or they may be giving more and more loans. So depending what are the current interest rates, that would impact impact the working capital management of the firm. In general, the economic factors, the GDP growth and all those factors, they impact the working capital management. The competition, the industry kind of factors, in which companies working capital loans are taken more, in which companies there is a self-sufficiency with respect to the working capital. And the innovations, new products coming up, they also impact the working capital management, because initially there could be a need for a capital in terms of marketing the product, in terms of initially designing the product, research and development. For all these purposes, there is a need for the working capital. So these are the factors that need to be evaluated at the outset before getting into the working capital management process for any particular firm. So an understanding of all these things is essential before going ahead in terms of taking up how to manage accounts receivables, how to manage inventory, how to manage cash, how do I measure the liquidity. All these things can be understood, needs to be understood to a great extent to make sure that we are implementing an effective working capital management process in the organization. All right. In this session, I'm going to look at what are the various measures that are available for the liquidity computations and how can liquidity be managed. So whenever we use the word liquidity, I am referring to the company's potential to meet the short-term obligations, whatever are the short-term payments that it has to make either to the bank or to its vendors or to the employees, whatever it is, the short-term payments the company has to make using the assets that it is having. Generally, the short-term assets which are either readily available in the form of cash or something which can be converted into cash quickly. So just by converting something into cash, how good is the company's ability to pay off all its short-term obligations? So that is where I look at what are the kinds of assets that are available with the firm, and what is the rate at which, or what is the speed at which they can be converted into cash. So either they could be sold, or probably using them I can raise some kind of finance, whatever it is. How good are my assets in terms of getting converted into cash so that I can use that proceeds for paying off my short-term obligations. So any company that is typically having excess cash, a good amount of excess cash with it, I say that the liquidity is not an issue for that particular company at all. It's highly liquid kind of a company which is having heavy cash. We say that it is having highly liquid, but probably that much of liquidity may not be desired at all, which means some of the cash it can put to some kind of a productive use. That's one dimension that we can typically look at. Whereas any company which is having a deficit of cash instead of surplus, that is where the company faces more and more tighter kind of financial situation. It may have to raise kind of loans in the short term to meet its obligations, and if things are going worse and worse, those are the companies where there is a possibility of bankruptcy filing or liquidation coming up. So that's where the company needs to evaluate its position of liquidity from time to time on a regular basis, right? So with that as a base, I would like to look at what do I really mean by liquidity management. So I am more interested as a company, I am more interested in seeing whether my position is liquid or in what kind of cases I may face the problem of liquidity. So here when I am talking of how well the company is able to generate cash whenever it requires. Whenever it is falling short, how well the company is able to generate the cash. So what are the kind of resources that are available to generate the cash? So either I can convert my existing assets, probably the accounts receivables, how well they can be converted into cash, the inventory, how well can it be converted into cash, or is there any kind of a possibility that I can extend my liabilities? Means the payment to the vendors, can I delay it? Do I have the luxury of delaying the payment to the vendors so that I can keep the cash with me and keep the entity completely solvent without going into insolvency case? So the whole idea behind liquidity management revolves around the short-term assets and liabilities, but at the same time I can even talk about the long-term assets, probably selling off the long-term assets like buildings, machines to generate the cash and make the payment. But that is a kind of a huge compromise that is happening. I'm sacrificing and compromising on an asset for a short-term cash. So though I can use long-term asset, or probably I can work out on long-term liabilities, means renegotiation of my debt. So instead of paying the interest and principal to the bank as and when required, we are delaying the payments on the long-term debt with the bank. All these, anything which I am touching on the long term, whether I am generating cash by selling my long-term assets or generating cash by handling the long-term liabilities, they they put some kind of an additional cost on my liquidity altogether. Though I am liquid, but that could be more and more temporary. It might impact the position